All right. Well, good morning, and thank you everyone for joining us for our next virtual discussion put together by iGlobal Live. Today, we're continuing the conversation on the future of hospitality, part 2, amidst COVID-19. My name is Anna Ivanova, and first and foremost, we hope that everyone is staying safe and healthy during these unusual times. Our core mission has always been to develop connections and deliver industry content between like-minded individuals. So for now, we have reinvented the way to facilitate this for our community through these online discussions. So what we have here for you today, I'm joined by a panel of thought leaders who are going to speak from their point of view regarding the future of the industry. A couple of housekeeping notes for our viewers before we turn to our panel. All of our viewers are on mute, and in the footer, if you move your mouse, you will see a Q&A dialog box. You can submit your questions to the panel, and towards the end of the session, we will address some of the audience's questions. Also, towards the end of the discussion, we will have 2 live polls. As one of our new features, we will prompt you to select which speakers you would like to be personally introduced to, and we will then be connecting you via email after the event. The second poll has been curated by the panel, and we will push a notification box on your screen that will prompt you to vote during the Q&A session. Please take a few seconds at the end of the session to interact with those questions, and we're going to tally them up at the end and display the results. Without further ado, I'd like to introduce and welcome our panel and the moderator, Daniel Lester, President and CEO at LW Hospitality Advisors. Daniel, on to you.
Anna, thank you so much, and good morning to everybody from New York. Before I go on, Anna and Marina, thank you so much for inviting all of us to participate on this panel. I know we're all very excited to talk about what's going on. Obviously, life is changing very, very quickly. So Anna just introduced me. I think many of you may know, and if you don't know, LW Hospitality Advisors is a national hotel-centric consulting, advisory, valuation, feasibility firm focused exclusively on lodging, hotels, resorts, casinos, conference centers. We have a division that also executes third-party asset management and development consulting services. And we recently launched an analytics platform, LARC, Lodging Analytics Research and Consulting. So hopefully that's my 60 minutes. I'd like to ask each panelist to also take no more than, not 60 minutes, 60 seconds. I'd like to ask each panelist to take no more than 60 seconds for the commercial. So I'm going to start with the way the screen shows you folks in order. And the first one up is Peter Burke. We can't hear you, Peter. Peter?
Can you hear me now?
Now we hear you.
Can you hear me now? Okay.
Yeah, you're looking much better today than when we had our rehearsal call, Peter.
All right, okay. Well, I got a good night's sleep in anticipation for today's webinar. So Peter Burke, I am president of PMZ Realty Capital Hotel Finance Group. We are a New York-based financial intermediary arranging exclusively hospitality loans in the United States. We do about $800 million a year. Debt, equity, joint venture, capital in major markets, as well as we do a lot of secondary and tertiary markets as well. I'm sure a lot of you have seen our name in the press, and anybody who wants to talk to us after this call, the contact information will be up.
Thank you, Peter. Chad Cooley.
Thanks, Dan. Chad Cooley. I'm the co-founder and managing partner of AWH Partners, a company I founded with Russ Flicker and John Rosenfeld about 10 years ago. Our company is focused on ownership, operations, and development, all in the hotel space. We have about 30 hotels across the country, primarily in the branded space, but some independents. We manage everything we own. We run all of our own developments. And we're, today, living the dream of dealing with all of our lenders and also thinking about how we're going to continue to grow in this environment.
Thank you. Thank you so much. Chris Full? We can't hear you, Chris.
There we go. Sorry about that.
No problem.
Thanks, Dan. My name is Chris Full. I am the Executive Vice President of Acquisitions and Development for Pyramid. Pyramid's about a 40-year-old company. With its predecessor company, we have about 140 hotels across the US and Europe. Our span of control kind of goes from Hawaii to Germany, down to the Caribbean. We have about 11,000 employees, and we're excited to be here today.
Thank you. Brad Walker, welcome.
Thank you. Brad Walker, Terra Capital. We're a real estate credit asset manager investing across the capital stack, all property types and markets throughout the US. More recently, while it's primarily been loan origination, more recently we've actually, we're pretty active in the public markets in terms of trading some REIT securities. And so we're fairly active within the more liquid public market side of the real estate sector.
Thank you. Thank you. So, you know, as I opened up with, you know, obviously the world is changing very rapidly, and you know what's occurred in well, what occurred the first 30 days, if you will, after March 30th, and what's March 15th, and then what's occurred since then. So during the past 90 days has obviously been, frankly, earth-shattering and volatile and changing every day. So as we sit here today on June 10th, I'd like to ask each of you to just sort of weigh in on, as of 11 a.m. East Coast time, June 10th, what's sort of on the top of your mind? And I'd like to just go down the line and, you know, maybe just take again another 60 seconds and tell us what's on sort of, you know, the top of your mind right now today. Peter, why don't we start with you?
Yeah, thanks, Dan. And you actually asked a pretty easy question for me, because there's something that's definitely right on the top of my mind. And that's how the lenders, and especially the servicers in CMBS loans, are going to treat their borrowers. You know, our job as intermediaries is we arrange financing with banks, credit companies, Wall Street houses, debt funds, every kind of lender you can imagine. And how the servicers treat their borrowers will be key to how, you know, when the markets come back, because people are going to need financing for hotels. So I'm confident that they're going to come back, but how all the different lenders treat their borrowers will be very important for what borrowers want to do with lenders in the future. So there's been a lot of focus on CMBS loans and how servicers are treating their borrowers, and there's a lot of legislation involved that we've been involved with AHOA and AHLA, and how that all plays out is going to be critical for the capital markets in the future. So that's kind of what I think about, and what we talk and, you know, counsel our borrowers on how to handle their various lender issues.
And that's great. Thank you, Peter. And we're going to dig into some more of those specifics. Chad Cooley, what's it's 11:08 on June 10th. What's on your mind?
Well, it's an easy answer. I think first and foremost is the health and safety of our many employees. For those in the field, it's focusing on what we do and doing it safely. As we're headquartered in New York, it's thinking about, for those of us at home, how we accommodate safely transitioning back into the workspace, which we're eager to do later this month or in July. And then, you know, I stay up late at night thinking about and awake sometimes in cold sweats. What is next? How can we get safely back to sustainable levels in the travel business and operating our hotels? How quickly can we hire back the many that we had to let go going into this crisis? And probably more than anything else, it's how are we going? What is the best way going to be? What is the path to getting deals done in this new environment? It relates to what Peter said, but really both on restructuring our existing deals for those that we continue to work on, and new deals. How are we going to get them done? And as we figure that out, that will be our path to growth.
Okay, great. You know, my bad. Joe Delisantini from MCR. Yeah, you know, the screen is small and I got all these pictures, and my apologies.
You're good, Dan. I was going to chime in at the end. Joe Delisantini with MCR. We're a hotel owner operator based in New York. We have about 90 hotels today. Most of them are Marriott and Hilton limited service, but we have a fair number of full service hotels, some of which are independent in New York and some of the areas around the city.
What's on your mind, man?
Yes. I'll kind of piggyback off Chad. I say it kind of jokingly, but Operation Warp Speed from Donald Trump is on my mind. because at the end of the day, we can all debate, some people are concerned about the pace of the recovery. Some people are concerned about financing markets, working with borrowers, but it's kind of a public health crisis at the end of the day here. And the recovery could be going fine, then all of a sudden, next winter rolls around, next fall rolls around, we have the virus come back, it derails everything that we've kind of worked on over the past 6 months. So I think that's the big risk here. And you don't see it in the headlines anymore. If you go to CNN.com, there's headlines about protests and maybe the upcoming presidential election. But this second wave, I think, is a real risk that could derail a lot of these conversations.
Unfortunately, that is the reality. Joe, thanks for joining us. And again, apologies about that. Brad, what are you thinking about?
Sure. You asked the question about at 11 a.m. Having just been more active the last really 3 months, more in public markets, that changes a lot more frequently than it used to, from having been focused primarily on private market loan origination. But from the public market perspective, it's been really tough to figure out, and it does change daily and hourly. I think looking forward, similar to what Chad and Joe were saying, it's really just trying to anticipate how the effect of a health crisis and how that can change, and how there's really no one. It's funny even listening to Warren Buffett. There's really no one out there who we used to look to as the sages who have any idea what's going to happen tomorrow and a year from now. And I think what we've been trying to focus on is looking around the corner, as Wayne Gretzky said, where the puck is going, to try to figure out and just think and talk to everyone we can, whether it's ownership or it's operators or it's just our friends who would be users of hotels, of how their minds are different right now and how we think we should be adapting or shifting our focus. But, frankly, from the public market perspective, it's very difficult to figure out what's going on, how the public markets are thinking. I couldn't hear two more different stories than what we see on the loan origination front or new investment front from what's happening to the REITs who have the underlying collateral.
Thank you. Chris, batter up.
Thank you. Yeah, like Chad, I've had some sleepless nights. I'm not sure I've had any cold sweats, but no, there's a lot to think about. Safe and healthy are number one, first for my family, and then secondly for our employees and our owners. Limiting liability, mitigating liability for our owners going forward, and then taking care of our guests when they check into the hotel. It's a huge project, and we're literally changing the way we do business, okay? And we'll talk about that, Dan, as we go on in this panel. But I think the other real element then is one of growth. We've been through every one of these downturns over the last 40 years. We have a path to grow. We've already taken over our first receivership assignment in the U.S. We act as a receiver. And it's a real opportunity to grow if you're aligned and know how to handle growth during these periods. And actually helping people that closed hotels, getting them reopened and moving forward. And then the massive job reopening virtually 140 hotels is that'll probably bring the cold sweats on, Chad.
Interesting. So the next question is essentially, has the recovery started? Okay, and if so, where are we? No innings, please. Okay, we got to be a little original here. But with that being said, Joe brought up a very interesting point about the potential of a second wave. I'm a bit concerned that we may see very soon now in the next couple of weeks the second wave of the first wave. The protests, the demonstrations, the riots, whatever you want to call them, there have been an awful lot of people packed together throughout the nation, and that really wasn't on the plan for mitigating the spread of corona. So I'm a bit concerned about seeing, again, the second wave of the first wave, and then to Joe's point, a possible true second wave in the fall. So Joe, has the recovery started?
That's a good comment, Dan, and it's kind of leads into my answer. And I think we're in the very, very early stages of this thing. You kind of look at travel, right, and you can kind of look at leisure, corporate transient, and group. The good news is there is some serious pent-up demand on the leisure side, especially in drive-to markets. People have been talking about it for the past couple of weeks, and I think it's very true. We have hotels in places, in the Mid-Atlantic and Corpus Christi, Texas, that over Memorial Day, are running nearly full at some of the highest rates we've ever ran at those select service hotels. So leisure travel is going to be there, but it's almost a guess as to when corporate transient and group comes back, and that's going to feed into the recovery. But until we figure out the health side, until we figure out what travel is going to look like, I think you have to call it that we're in very, very nascent stages of a recovery.
Right. Dan, can I just jump in here for a second? I spoke to a lot of people at the beginning of this week, and we do a lot of work in the Southeast, and a lot of the drive-to markets and limited and select service hotel owners have said that they think that they'll break even, including debt service, for the month of June, and expect to kind of break even until there's some sort of recovery or something. So I think that it's kind of a tale of two markets: the drive-to hotels, which will start to recover and break even, and maybe even make a profit, versus the group hotels and the downtown hotels, and the larger big boxes that will have a much tougher time as people will go to conventions and corporate travel and stuff like that. So I think the recovery has started for the limited and select service markets.
Chad, and then Chris, I'm going to ask you to weigh in, and then we'll move on. Go ahead, Chad.
Yeah. So on April 9th, I think, or around then, we did 5.9% occupancy across the portfolio. Last night, we did 25%. So by that definition, clearly the trajectory is headed the right direction. But I think in the hotel space, aside from these isolated drive-to hotels, which Peter just referenced, I think the damage has been done. The market evaporated, and the vast majority of hotels aren't going to break even at 50% or many even 60% occupancy, particularly with the battle over ADR that's going to unfold over the next 2 years. So there is this massive balance sheet problem in the hotel business, and that is going to weigh on our space for the foreseeable future. It's going to lead to, right now everyone's got PPP, everyone's got loan forbearance, everyone's got cash on the balance sheet. But like fast forward 90 days, that's all gone. And when the world's kind of like, everyone's like, thinks the world's back, and Trump is like, no way are we going to do another bailout. And lenders are like, wait a minute, you should be recovered by now. Guys are going to show up with $0 to pay their payroll and their utility costs and their taxes, not to mention debt service. And I think that's going to be an unprecedented level of distress. So while the recovery has certainly started, the damage hasn't even begun.
Thank you. So Donald Trump's name has now been invoked twice. Hopefully this conversation is not going to get political, because if it does, I'm going to hand the baton to one of you gentlemen to moderate.
Not intended as a political statement. It was just,
Chris, why don't you give us your 2 cents? But I'd also like to weave it into another question, and then we can come back to some of the guys on this second question. Has the looting and the violence that has occurred in major 24/7 downtown urban cores set back the recovery for those markets? And if so, to what extent?
No question, Dan. And just one more Donald Trump. I tried the Clorox thing. I tried the Clorox thing, and my hair turned white, but it didn't solve my problems. But anyway,
you look
great. You look great.
There's no question that it has. I live in downtown Boston. I'm sitting in downtown Boston, 3 blocks away from Newbury Street, that has boards in front of all of the major upscale shopping areas. When you look at it internationally, and I talk to our hotels in Europe on an ongoing basis, they're saying, what the hell is going on? I think there's going to be a real negative effect about travel internationally into the U.S. And there's no way right now you'd really think about, traveling to New York City, Chicago in particular, with what's happening, and not worry about the safety factor. So there's no question, to speak nothing of the fact of when is this retail going to start opening, which is one of the things that generates tourism and contributes to a gross national product. On the recovery, I looked at China a little bit in terms of what's happened, and there's been some significant upticks in Chinese travel, and they're way ahead of us in the recovery as it relates to health. Europe and Germany and those countries are ahead of us also, and you're seeing that same trend toward huge leisure travel to drive up destination resorts, and the same thing in the US. I'd agree with Joe on the corporate group convention side, toss up. And there's no question that Zoom and Microsoft Teams and those things are going to affect the way people think about that a little bit.
All right. Thank you.
Does Chris think that's going to be an ongoing thing? Because that's something I think about a lot. the trend moving towards Zoom and working from home, or once the virus passes, like, are we re-educating people that they can work from home and they don't need to travel as much? What are your thoughts on that?
We've talked to a lot of people. We're actually not opening up our offices in Boston. We've got about 120 people until September 1st, and we're just trying to take into consideration safety. The city's 25% open, but yeah, I think it unquestionably will. I know it even affects me. I see it as I didn't use it extensively before, and I travel a ton, as I'm sure all the rest of these gentlemen do, and there's no question it will affect it. It will not replace it. As it relates to office, I see, and you talk to people, it's going to be more of a fluid office. I don't think offices are going to close. I think you're going to find that the collaboration, the innovation that comes from teams working in office will continue. But I think you'll have a situation where if I went in the office 5 days a week before, I'll be able to use 2 days away from the office. So I don't think that'll go away. And one other point I'd raise about the whole Zoom thing, and it's been very effective on the short term, and it still is effective. But everybody's working for the most part with people that they know. On a long haul, as turnover occurs in companies and you don't know these new people coming on and you don't have relationships with them, we think that really is going to push back toward people being together. It's not going to replace it, but there's clearly an effect with Zoom and Microsoft Teams and all those as it relates to travel.
That is such a terrific point, and I absolutely agree. I mean, it's human nature to look other human beings in the eyes. And very good point, Chris. Like, for example, here on this call, we all know each other, but you're 100% right. A couple of years down the line, it's going to be a whole different cast of characters. So great point. How about this? Somebody on this call mentioned earlier confidence, right? This is all a confidence game, and that's really what the issue is. People are not confident, right? So has the travel sector as a whole, done enough to come together? So, cruise lines, airlines, hotels, in terms of coordinating an approach and a unified approach to try to build up confidence. I really haven't seen it. Maybe some of you have, and if you haven't, any ideas? I don't know, Brad, do you have any thoughts on this?
I haven't really seen it so far as in terms of a concerted effort. I think I would direct it more to a Chad or a Joe or a Chris in terms of at the operating level.
Who wants to take the baton?
I think it's a good point, Dan. Like when you talk about winners and losers, I think like the guys like Airbnb are going to benefit from this because I think consumers are going to be a little more confident of going there versus a hotel in the near term. I think I saw some stat that like their bookings around Memorial Day were actually more than they were last year. So I think the hotel industry has to do a better job of like broadcasting. I think Marriott just rolled out a commercial about like keeping their hotels like cleaner. And I think you're going to see more and more about this. You see hotel companies all the time coming out with press releases about what they're doing to make sure your stay is clean and how they're sanitizing their properties. Marriott and Hilton are going to roll out programs with electrostatic sprayers that look, inevitably, whatever they do is going to cost us money. But, it's going to be for, the greater good of making sure everyone has a healthy stay. But I think it's coming, and I think you're going to see a lot more of it over the next month or so. Is my guess.
I'll actually pick up from there. I'll pick up from there, actually.
Okay, one at a time. Brad.
Sure. Yeah, just picking up on that, there have been a few ads, or I think what has been interesting, whether it's advertising, online notices about what hotels are doing to try to, it's almost a little, to me, it was a little dystopian. I won't mention specifically where they were, but just looking at some of, advertising really on the cleanliness of a hotel, looking at luxury product, resort markets, and instead of seeing something, instead of seeing a great dinner, instead of seeing a comfortable hotel room, it's more focused on people sanitizing elevator buttons and sanitizing the lobby, which to me, I'd prefer just to stay home if that's going to be the world. But I do think, I do think Chad said it best, touch on one of the questions earlier, is really what we're seeing now. Yes, occupancies are ticking up, and I think we have to all be careful that when STR is counting that data, they're excluding the hotels that are closed. So I think we have to be careful even looking at the occupancies now, given, 15% of hotels nationwide are still closed, 60% of luxury hotels nationwide, 40% in New York City. So to be careful with that in terms of being optimistic, but yes, as Chad said it best, I think the consequences are going to be from a financial perspective for years. And I think be hard to deny that the social consequences in terms of how we think about life and how we think about operating a hotel business or a restaurant are going to change permanently. And I don't see any way they can't.
So, Dan, if I could make a quick comment on that, just real quick, I take a little bit of a contrarian view to Joe as it relates to Airbnb, and there has been studies with consumers that have said that they may not be the winner, and I agree with what Joe said. They've had some pretty good upticks in terms of reservations, but when you talk about Airbnb had some security issues before, even the way people thought about the brands and the way they control things, and I don't think that they're going to be able to standardize or control the approach as it relates to cleanliness, the way the brands are going to market themselves from a consumer confidence perspective. So that's just my take on it. So
and I agree.
To add to that, to add to the Airbnb fallout, to add to the Airbnb fallout, you have these platform owners that have just been eviscerated. You know, like in the hotel space, we were, at least a lot of us were institutionally capitalized, and we have some deep pockets to call on. But a lot of these owners had 80%, plus mortgages on condos in markets that have been empty for the last, other than Memorial Day weekend, which, yes, Memorial Day weekend was great for Airbnb, but, their bookings in houses, which I think is a product that they're uniquely, good at or uniquely positioned to provide, has done fine and will continue to do well. But I think their days of being a threat in the hotel space, I think, are limited, or at least are going to be different over the next year or two, when people are focused on standards of cleanliness and, an well understood product once you open your door to your hotel room, which you can't get in an Airbnb hotel.
Peter, so I'm going to make myself. Okay.
Yeah, well, that's exactly what I was trying to chime in before. Exactly what I was going to say. I mean, I think the confidence level and the brand standards will drive people more towards hotels and kind of away from Airbnb.
Yeah.
Until this crisis is over.
Brad, you
sure.
want to say?
Take the risky venture of making myself persona non grata on this phone call. And for years, look, I remember hearing the Airbnb executive team at a ULI conference at one of the lodging panels. And for years, I resisted it personally, and I agreed wholeheartedly with most of the lodging industry that it wasn't sustainable. But look, I gotta be frank that they proved everyone wrong, including myself. And I think we may be looking at the wrong question of, what will Airbnb be, and how will the protocols be? The whole reason Airbnb came out of nowhere and took the whole hotel industry by surprise was their ability to innovate and their ability to think faster and adapt faster than other groups were, than other hotel owners were. And I think now, having stayed in Airbnb in recent weeks during this, I gotta say, while I love my boutique hotels and I've never been a fan of an Airbnb, and it's always had some parts that were weird to me, once we got in, cleaned it ourselves, cooked ourselves with a bunch of friends, there are a lot of elements that felt a whole lot safer than going to a hotel right now. And I think, again, I challenge everyone, I think the key takeaway here is not going to be what Airbnb was, but it's how quickly Airbnb was able to innovate and really outdo everyone, and to certainly not discount their ability to pivot again.
Yeah.
I agree with Brad. I think they're uniquely positioned. If we all believe the leisure traveling is coming back first and Airbnb picks up most of their business from that traveler, if they do a good job of executing over the next 6 to 12 months, that could create a lot of long-term value for that company. So long-term, I do think they could be a winner, but we'll see.
One quick economic indicator, Dan, I just wanted to mention that we've talked enough about Airbnb, but I've got 5 kids that were the biggest Airbnb users in the world, and they've started calling me back wanting their Marriott employee discount cards back, or associate discount cards. So
love it.
Just a small indicator.
Love it. And I just want to weigh in 1 second on Airbnb, and then we definitely will move on. Given that their market cap has eroded by more than 50%, we're all aware of that based upon the 2 rounds of funding, that very expensive funding, I would say, that they recently took down. I've actually been saying for quite some time, and this is based merely on my gut from 40 years. I'm not spreading any rumors here, but I really believe, and I believe the chances of this happening now are even greater because of the erosion in value. I think one of the big brand families is going to figure out a way to bring Airbnb under their umbrella. And if it happens, remember you heard it here first. If it doesn't happen, just forget I ever said it. All right, guys? All right, let's talk a little bit about, when we get back to quote unquote stabilized levels of operation, right? For, let's talk broadly, full service and select serve, even though today, I think most full service hotels that are either open or plan to reopen are going to be open with a select service model. But putting that aside for a second, on a stabilized basis, somewhere down the line, do the economics of operating a hotel long-term fundamentally change going forward? And if so, how? Chad.
Yeah, I think there's no doubt that what the brands are going to require and what independent owners will, I'm sure, do to stay alive themselves is institute new standards that have costs. And that's in the way you clean the hotel rooms, and the way you clean the public areas, and the way you train your staff. Those all will have ramifications, which will hurt margins. I happen to believe, I'm bullish and believe that we're going to look back in 3 or 4 years, and things that we say today, which are permanent changes to the world and to the hotel space, and what we think, everyone wearing masks or 6 feet of separation and people being so focused on cleanliness, I think we'll look back and it'll be a distant memory. And at that point, the question is, has the hotel business changed? I think the cleanliness standards will remain, and a lot of those expenses will be there. But so the costs will be there. But I think at the same time, hurting value will be institutional memory of how this shock hurt the balance sheet, how this shock hurt all of our investments, which ultimately is going to reverberate for years to come and impact the value or the cap rate with which new buyers will come into the business, and with which how lenders view their cost of capital. So I think those shifts not only will have reverberating impacts over many years to come, even if we forget our desire to be in super clean spaces or remain 6 feet apart. I do think values are permanently changed for a 5-year period. That over 10 years, who knows?
When does the United States get back to 2019 RevPAR levels? Why don't we go around the horn? Just give us a year. Brad.
Sure, I'm on the longer side at 2023, 2024. I have no idea, but taking on the previous question as well, I think what's important to realize, everyone's focused on really occupancy. As Chad said, there, people are saying there aren't going to be rate wars. It's hard to imagine that being the case. And I think if you think about, the economist, I really think put it best a couple months ago when they talked about the 90% economy in China and what that impact would be on the US. If you just think about that, we're talking about at the end of 2021, RevPAR being down 37%, according to SCR's latest forecast. And if you think about not only that, not only rooms, but other revenue, if you look at group hotels, if you look at F&B, the amount of total revenue they'll be down. And if you think, revenue is down 30% or even 25, call it 25% over a longer period of time, given how high fixed costs are at hotels, that's 40% cut in profit. And so yes, I agree. I don't think it's going to feel as dystopian as I said before. In 3 years' time, I think a lot of people will relax. A lot of people end up reverting to the mean and reverting to what they want. But very modest, given hotels and especially restaurants and ground floor retail that could be part of these hotels, really modest reductions in revenue and slight changes in the way people think. 10% of group hotels, groups not booking anymore, or cutting the rate, or only bringing 50% to one of the conferences, to ICSC or Alice, to any of these conferences. That has a huge impact for these hotels. And it's going to really depend on the cash position they had now to be able to see how they can deal with that. Right. But if they're cash short, they're not going to be making it, even if we do feel like we're in a normal state.
Thank you. I just want to go around the horn, give a year. Joe, when does the U.S. come back to 2019 RevPAR levels?
Holistically, like looking at everything, 24 or 25.
Peter.
Dan, that will be 2022 because we're going to have a vaccine in 2021, and there's a lot of pent up and leisure demand, and people will satisfy themselves in 2022. So
I love it.
2022 will actually exceed 2019.
Chris?
We're saying 2023, and I agree with Chad. And you know, in the previous, there's going to be a vaccine for this thing, and we've learned how to handle these better going forward. We're more aware of it, and I think things are going to return back to normal. We're in a recession now, right? We're in it. So, but there's going to be some difficulty in the next 24 months. But I think it's going to be 2023, and I think people will travel. The world will travel.
Thank you. I love the optimism. We're in the hotel business, right? If you're not an optimist, you're not in the hotel business.
That's right.
Chad, did you weigh in on?
No, I didn't. I want to thank Chris for his statement. I totally agree. To my previous comment, people are going to look back in 3 or 4 years, and we're going to all be in a big ballroom somewhere celebrating. And remember when we all said the meeting business is never going to return? So I'm also in 23 or 24, probably more like 24. But I think, you know, our profits in 2019, we might not see for, 7, 8, more years to come, because that impact on the margin from cleans, from, just inflation. If you're returning to 2019 RevPAR in 2024, you're not getting to peak profit for many more years.
So guys, when we're in the ballroom, okay, all together as you described, okay, I don't know about any of you, but I'm not shaking any of your hands, and no man hugs, at least for me.
We'll give the...
Peter, let's talk about, the debt markets. They're going to come back, right? There's no question about it. But how does that, when do you think it happens? How does it look? Is it different than what we've experienced in the past?
Yeah, I think the debt markets are here now in some respects, the local banks and stuff like that for recourse loans. And that depends on, somebody's personal balance sheet and stuff like that. But the capital markets, the CMBS markets, I don't think they'll come back until they can have some sort of forecast in terms of where, revenue is going to be. Nobody knows, what's going to happen next year. Nobody knows whether there's going to be a second wave or we at the bottom, So I think the CMBS market, until there's some sort of vaccine or therapeutic, is kind of on hold. So we're at the mercy of banks and credit companies, which are the only lenders out there. And that depends on a relationship that a borrower has with his local bank and the leverage level. Absent that, there's a whole bunch of preferred equity that's been raised and rescue capital. And that's the type of stuff we're working on to kind of fill in the gap for people who unfortunately have their loans coming due in the next couple of months, between what they need and to pay off their lender and what they need to keep their hotel going.
Great, thank you. So let's sort of advance the conversation. I'm looking at everybody on the screen here. I think I've heard from each one of you during the past 90 days that you either have a pool of capital or you have access to a pool of capital. And Dan, if you come across any opportunities that are compelling, please let us know. So with that as a backdrop, assuming, and those opportunities will come around, how do you underwrite an asset today? I mean, listen, we all know it's a cash flow, premise in terms of hotel investment, but an opportunity comes along. Describe how do you size it up, Chad?
Yeah, so
big dartboard, right? Big dartboard.
What's that? Big dartboard. Well, you got to make assumptions. We started our process of thinking about new deals with the benefit and the backdrop of re-underwriting our entire portfolio, looking at every asset, thinking about how much cash is it going to take us to get from here to the end of 2020. How about 2021? How about 2022? And so once you establish that framework, you can fairly easily extrapolate it to new investments. I think, we do believe that 2023 or 2024 is a reasonable time frame for return to 2019. So you layer that in. Obviously, that's not going to all happen evenly. It's going to happen a lot more upfront and then slow down. How do you underwrite, financing? You got to either assume you're all equity or assume you're borrowing at 50% at exorbitant costs. How do you underwrite exit caps? Is it 200 basis points wide, 300 basis points wide, 400 basis points wide, where we were in 2019? If you add all those things up, you're never going to buy anything. So you got to add it all up and massage and see where you are. But, we think to buy today, you're looking at 60 to 70% of 2019 value, based on some combination of those assumptions, if you're going to have a reasonable return.
Thank you. Joe, why don't you weigh in on this?
I totally agree with Chad. I think he hit the nail on the head. That's exactly how we're underwriting it. How much cash beyond just the purchase price and the CapEx that we all know we're going to have to spend are we going to have to put in to carry an asset over the next 12 to 18 months? And if you underwrite a recovery to 2024 or 2025, layer on, according to Hotel Ave, an extra $3 per occupied room for cleaning costs, that generally shakes out to a, plus or minus 30% discount to 2019 values, if not a little bit more. Because of that reason, 30%, that's a lot. There's going to be a bid-ask spread for quite some time. I truly believe, it's not going to be until the end of 2020, early part of 2021, where you see the transaction market really start to heat up. The good news I will say is we have had a couple of our balance sheet, more local lenders come up to us and say, hey, just so you know, we're not closed for business. It's going to be a 50% LTC deal versus 65% 3 months ago. The spread's going from L plus 2 or 225 up to, at least 350. There are going to be lenders that are active. You're going to have to, use different avenues, but there will be, I think, debt out there if you have something coming down the pike.
Let's talk for a minute about technology. And I think, I forget, maybe it was you, Brad, or Joe, said that, Airbnb, what was the secret to their success was innovation, right? I think, unfortunately, the lodging industry has always been a little bit slow vis-a-vis innovation and more reactive as opposed to proactive. This may be very much an inflection point, and the industry might finally get that they better be proactive. So with that in mind, does anybody have any ideas about, how new technology is going to, to fit in with future hotel operations? I mean, obviously, the keyless entry, which has been around for quite a bit on your phone, and the check-in, right? But only reserved for exclusive, frequent travelers. That's open for everybody now. Anything else that you see down the pike? And I open it up to whoever's got some ideas on this.
I mean, China's using robots extensively in cleaning and operating hotels. We have one robot at one hotel in California. I'm not sure that's going to be a huge trend going forward. Communication, I think, is going to be key, and I see upgrading communication and the ability for people to use things in guest rooms. It would be a priority. And then also communicating to employees in a world that everybody gets shut down and lives distance. A lot of companies now have mobile apps where they can communicate and talk to all their employees. I mean, we've got 11,000 employees, and we're in the process of implementing that. But an app where you can literally talk to them and communicate them on an ongoing basis, daily, if you have to, about what's going on. So,
I humbly believe, this is my opinion, and I'd like to kind of get, reaction here. There's going to be a ton of opportunity, right? And we all know that, there's a ton of dry capital out there. And we also know that when the opportunity comes around, there's a lot of stuff, if you will, that not a great story, right? But there always are that, those opportunities that have real, true value add play opportunities, right? And the smart money is going to gravitate towards those opportunities. And I humbly believe that with all the dry capital out there, those distressed opportunities are, because of all the capital that's out there, are going to get bid up. And so it'll be distressed transactions, but in my opinion, not distressed pricing. Any reaction? And again, that's for a very, small segment of the investment opportunities that are going to come around.
Right now, cash is king, right? And we talked about there being sort of a lack of debt, but the groups that have cash and are trying to be all cash buyers, the major private equity players, are out there trying to buy things at the perceived 40% discount, 30 to 40% pre-COVID. And in general, it's not happening. There's been very few examples of that actually happening, even with the REITs that are under distress. It's been very slow to actually trade stuff. There's been some examples, but I think there is a ton of capital. I mean, we have weekly calls with a lot of our major capital partners, Goldman Sachs and Fortress and people such as that. And there's just so much capital out there that I think that possibility exists. And I'm not sure, even as things progress, you're going to see this 30 to 40% drop in values for quality assets in good markets and good locations.
Chad.
Yeah, I think that dynamic of so much capital can change quickly. And why I might disagree, Chris, is I think there could be a rush of a lot of opportunities that need capitalization between late this year and mid to late next year, because I think there's more capital, there's more liquidity shortage in the asset space in our business than people are giving credit to. So we have a number of specialty service or really CMBS loans. Those lenders aren't even talking to us. So they have no idea that if I'm not going to put money in myself later this year, that not only are they going to need to advance to their bondholders, but they're going to need to advance to pay the bills for payroll and for the electric bill. And that dynamic is not unique to me. That's everywhere, right? That's the entire country. That's the entire world, frankly. So I think that dynamic will lead to quick executions. Only quickly does a 30 to 40% discount happen. And
That's right.
Lead to these capital inefficiencies where tons of capital providers are out there saying, we have capital, we want distressed investments. But how many have the capability, the knowledge, everything else you need to bring to the table to move on a deal in 2 weeks,
What you're describing, Chad, is absolutely, and I agree with you, and that 30 to 40%, that's really probably more reflective of a liquidation value as opposed to market value.
I agree.
Because the fundamental definition of market value is willing buyer, willing seller, neither under duress. So I think you're absolutely spot on with that.
And a lot of those people might come in as preferred equity or mezzanine as opposed to just an all-out asset purchase. And I think that's a lot of what we're going to see too. So not necessarily trading, but just coming in and as rescue capital.
Agreed.
We're already seeing examples of lenders, of owners giving the keys back to lenders, and even lenders are smart. I mean, in many cases, they may try to even hold on to those and see what happens. And but it's going to be very interesting to see. What has surprised me in talking to all of the array of 50 capital partners that we do business with, all of them, none of them, almost across the board, have lost interest in investing in hospitality. If you look at the Goldmans, the Fortresses, the Blackstones, most of them completely got into hospitality in a big way at the last downturn and completely got out of it just before this. You tell me how they know that, but they're smarter than we are. And they have a ton of money to get back in at discounted prices. But I agree, it's not going to be typically a 30 or 40% discount for good assets.
And look, we're on a hotel call now. I think one thing to consider is really just the amount of dry powder is obviously higher than ever before, but the need for it is greater than ever before. As well, it's not only hotels; it's every, frankly, even the safest real estate property types like industrial are going to have issues where that capital can also go. And speaking of the major funds, yes, they have a ton of dry powder. They're going to be eager to get in at distressed prices and say, as Fortress says, they're the trash collectors. I think they say that proudly. But I think what's important is, looking at Chad, Chris, Joe, with hotels especially, no one can do that without the operational expertise. None of the funds can do that, or certainly very few of them. And they're certainly not the mega funds who are accounting for the vast percentage of that. So when you look at a hotel, I mean, most of us are afraid to, even the operators who Chris, you've been in this for 40 years, you still don't have, this specific experience, but people are going to be looking to you more than anyone else in your type of expertise, because otherwise, you talk to a lender, you talk to a bank, certainly, but even a Fortress, even a Blackstone, they're not going to be willing to jump into a 20% occupied hotel right now, where they have no idea how to innovate and create the protocols for bringing back operating value to it.
Oh, you're right, Brad. They need quality, institutional quality, sharp operators. It's amazing how much knowledge in hospitality these major funds have gained over the last 5 to 10 years. They're pretty smart, but they need us. There's no question. And the other trend that we see occurring right now is the fortresses, and I use them as an example, but all of these funds looking at going after illiquid, maybe smaller operating platforms that allow them to get to the real estate. And that's something that's happening as we speak. You know, and it's a pretty interesting trend. We're actively involved in it ourselves in many cases. So there's going to be, I think, a consolidation and there already has been over the last 3 or 4 years, but a continued consolidation, I think, of operating platforms getting bigger and stronger and whatever.
That's actually a great segue to my next question. I wanted to throw out, who are going to be the winners and the losers when on the backside of this?
The real winner in the next 12 months is going to be the consumer, being able to stay at great hotels for very inexpensive prices. I think you're going to see that in many cases. Okay. Again, the resorts and a lot of the things that people mentioned, the prices are being run up already, but there's going to be some great buying consumer opportunities, I think. So there's going to be an opportunity, which I think will spur on travel. So,
Chad.
I think to echo something Chris said, I do think well-capitalized platforms that one, had the capability of withstanding the shock without too much damage, and two, have the ability to move on new opportunities, stand to gain. And that's not just your traditional private equity platform or large investor. I think, you know, that exists at every level of the industry. At the kind of most entrepreneurial level, some were over leveraged and some were conservatively leveraged. And, you know, so I think at every level, there's going to be winners who were probably just financially, you know, in a more sound position going into this, whether by luck or you know, intention.
Right. I could agree with Chad, but for a slightly different reason. I think it's the well-capitalized owners, but I think the well-capitalized owners, because a lot of their neighbors and other properties who aren't as well-capitalized are going to have a lot of operational issues and maybe management company changes and stuff like that. Maybe the lenders are going to foreclose. So they're not going to be as organized as the well-capitalized owners and as consistent as the well-capitalized owners.
I'll pose this question to the group. What do you guys think about the publicly traded REITs? I think you could probably argue that they're some of the most well-capitalized companies out there. People are criticizing them for having boatloads of cash. And right now, Sunstone and Host look like absolute geniuses. So what do you guys think about their prospects?
Sure,
well,
I can find that.
Go ahead. I think, Brad, you're probably most confident.
Yeah, you're the best.
Sure. So I'll take that. Yeah, I mean, they are sitting on the most amount of cash. You know, being larger in general, regardless of industry, is proving right now to be a boon to most of these guys. So certainly relative to some of the smaller operators, but you know, they certainly have their own issues themselves. You know, I think you guys probably know some of the lodging REITs who may have great assets and even assets that will be coming back pretty quickly. You know, not to name one though, you know, I think is just a good example anecdotally, is a Hersha, you know, who has a lot of cash on their balance sheet. They are, you know, they've been generally concentrated in select service in New York City, which, you know, pre-COVID has been one of the best things you could be. And they're doing better now because they do have scale within the city, and they do, and you know, it's lower price point, but at the same time, you know, what's going to happen to it in New York, we don't quite know. And a lot of these guys are, you know, as much cash as they may have, they have all the more debt for that cash. And while they may be able to get some forbearances right now, and this is speaking broadly, you know, they're still coming up against covenants and technical covenants that they'll be tripping, that they're going to need to be relying on their lenders and their bank lenders to be able to provide that cash, or to be able to provide covenant relief for.
Great.
So
Great.
I think that's something hidden.
Thank you. Anna, I see you're on the line, and I also note what time it is. I'll hand it back to you for the moment.
Yeah, sure. So just a quick reminder to our viewers, please feel free to submit any of your questions to the panel in the Q&A dialog box that is right in your footer. While we go into just some closing thoughts, I think from the panel, we're also going to push out a live poll for our viewers. So again, the poll has been curated by the panel. Please take a few seconds to interact and vote with the questions, and then we're going to tally up the results, display those at the end, and get some final comments from the panel. So Daniel, back to you. I think just while people are voting, for some closing thoughts on the panel.
So I alluded to earlier, you know, we're hotel people first, everybody on this line. And then real estate and operational folks afterwards. And, you know, hotel people are, and the hotel business is fundamentally a hospitable business and warm and friendly and bright and positive, right? Frankly, at the end of the day, it really doesn't matter what business you're in. I don't know too many people who like hanging around or speaking with folks that, you know, see things and life negatively. So with that as a backdrop, you know, I'm an optimist at heart. You know, when I look back on my life, I can think back to one of the first memories that I have is in 1962, back when there was black and white TV with 7 channels, and after the news at 10 o'clock, which back then there really was news, news programs, if you will, without opinions. And hearing about the Cuban Missile Crisis as it was going on, right? And then after the news, the TV shut off and you got to fret all night about, you know, are we actually on the verge of nuclear war? And it was like, oh my God, the world's about to end, right? Then you fast forward to the 1970s during the Arab oil embargo. I know there's a bunch of people on here that they were dreams in their parents' head and don't remember these episodes. Chris, I think you and I are maybe of the same vintage. But the Arab oil embargo, right? It was, oh my God, the world's, you know, going to end. There was gas rationing in the United States. You couldn't fill your car with gasoline, right? The 1987 stock market crash, 500 points, which represented 22% of the stock market's value. Today, what's 500 points? But the reality is that there was this incredible fear that got baked in. 9/11, the last financial crisis. My point is that we've been to this movie before, right? And while we haven't been to this specific movie, we're going to get past this. It's human nature to survive and strive and do well. And I believe every time something like this happens, when you look back, invariably the next peak ends up being better and higher than the prior peak.
I think what's happened over the last 3 or 4 years is that travel has kind of gone on being a
Chris is breaking up, no?
Chris, I think we're having some audio issues with you.
No. If I'm not sure.
I'm going to put you on mute just because the audio is so bad. And if you don't mind, actually, if you want to maybe disconnect and log back in, we're going to be here. But the audio is pretty terrible for the time being. I'm going to jump in actually because we have actually quite a few questions that just came in from the audience. There are about 4 of them. So I will go through them one by one. So first question is for hotels going to special servicing. Are they liquidating the hotels at any discount? So who would want to take that one?
That should probably go to
that one's probably for me. And the answer is no. The hotels in special servicing, most people have gotten 3 months forbearance at the master servicer level. It's possible they might go to the liquidation or foreclosure down the line, but right now it's way too early for that. I have not heard of any instances.
Okay. All right, I'm going to move through these pretty quickly as we're kind of running out of time here. Next question, can you provide more information on the impact of COVID-19 on CapEx for new hotel developments and renovations?
I'll take it quickly. probably only been one trend in the CapEx world, and that's that we're getting a lot more relief, a lot more flexibility from brands that we had historically. I think that will remain true for a while we all work through this and repair balance sheets. At the same time, there are going to be costs related to, cleanliness standards, buying the new equipment and so on. That will be incremental. I don't see that as being meaningful, but it will be incremental for a while.
Okay, all right. Next question. Do you anticipate that there will be continued development in the extended stay venue during this period?
Am I back online or not?
Yeah, we can hear you now.
We're in that market already. We're growing extended stay in Europe where it doesn't exist. Yeah, I think so. Look what Blackstone just did. In the last 3 downturns, they've invested heavily in Extend America. So I think so. I think it's a trend that has performed better during the downturn, and we're building extended stay hotels as we speak, and we feel pretty good about it. So we think that's a very positive market to be in, segment to be in right now.
Chris, I agree. I mean, not only Blackstone, but Barry Sternlicht through Starwood Capital has also made a significant bet on Extended Stay America. And let's face it, those two groups are smart folks. They don't bat 1,000, but they have pretty good batting averages.
Yep.
All right, last question. This is an interesting one. What percentage of hotels will be converted to other uses and cease being a hotel going forward? When will such conversion opportunities show up in the marketplace for opportunistic investors? Who should take that one?
I don't know about the percentage, but I mean, MCR would have a good comment on this, I think. I mean, I understand like in New York City, there's 17,000 rooms that will not reopen, which is a different question, but I've heard that number. And it wouldn't surprise me, frankly.
Chris, that's 100% right. In a market like New York, I think everyone's looking at the 200 plus hotels shut down, many of which are union hotels. They're going to be too expensive to ever operate as a hotel again. So I think you're going to see a significant number get converted to other uses. One of the more interesting things, though, is in some overbuilt markets, I'll call, in like some areas of Phoenix of the world, we've been approached by a lot of developers looking to, convert a Spring Hill Suites to a multifamily or even, an assisted living facility. So, I don't think that's going to be anywhere like 10 or 20% of like hotel inventory, but that is out there. And even the other day, I don't know if you guys saw it, but there was a Holiday Inn on 10X in downtown Baltimore that literally sold for $20 million, which was 2X more than I think anyone would have thought because it was bought by a multifamily developer. And, $50,000 a key is a good deal for them. But, you're sitting with, 5 guys on the phone here where, they would be scratching our heads at paying $50,000 a key right now for that hotel. So you're going to see some of it. It's going to be more prevalent, that's for sure.
All right, with that, we have our poll results, which I'm going to share in just a minute. And they're quite interesting, so I will read through them. Which of these do you think will have the greatest impact on our industry ability to recover fully? And it looks like overwhelmingly the answer was the virus resurgence. Next one, does this pandemic change your willingness to invest or lend in the hospitality properties? And it was almost a tie, but it looks like it's first, the winner is decrease it, followed by increase it. So quite a bit of a split audience there. Which demand sector will change the most even after a vaccine is available? And it looks like the winner is corporate group. So with that, gentlemen, any closing thoughts before we wrap it up?
I gave mine already, so I'll pass the floor to anybody else who wants to weigh in.
I just want a list of the people that said that they would increase their investment in hospitality. If you can get me that list, Ed, I'd appreciate
it. Agreed.
Anna, thank you again for coordinating this, and Marina as well.
Absolutely,
gentlemen. I'm sure my fellow panelists did as well, and really wish everybody, health, safety, happiness, and in New York, the sun is shining today, and there are no clouds in the sky. So, God bless us all.
Just a couple of closing words from my end. Thank you to the panel. Thank you to the viewers for joining us today. A copy of this recording will be made available. You will receive an email with a link to download it. We have several other live experiences scheduled for the next few weeks. We encourage all of you to join us for those as well. Tomorrow, we're hosting a discussion with keynote speakers, including Sam Zell, Francis Greenberger, and Raul Idnani. So we look forward to having you join us for those. Thank you again to the panel. Until next time, stay safe and healthy and have a great rest of the day from the iGlobal team. Thank you, everyone.
Thank you.
Thank you.
Bye-bye.